Cost segregation is a tax planning strategy used by savvy commercial real estate investors that accelerates the depreciation of certain components of their properties. In return, this can reduce current tax liability, resulting in upfront cash flow. Think of it this way: the benefits of cost segregation are comparable to borrowing money from the government interest-free, allowing you to do whatever you want with the cash. Use it to make improvements on the building, or better yet, use it for the down payment of your next acquisition. The opportunities are endless. Let's dive in. Your building has value, and over time, that value depreciates due to normal use and deterioration. In years past, the IRS considered a building as a single asset which was depreciated straight line, over 39 years for non-residential properties, or 27.5 years for commercial residential properties. What does this really mean? Let's say you own a non-residential commercial building. During the last 39 years of ownership, you get a tax deduction of 1/39th of the building's value each year. Although these depreciation expenses are helpful at tax time, there's a smarter way to do it. We all know well that most components within a building don't last 39 years. Over time, the law has evolved to align with this reality. Today, pieces of the building like carpeting, specialty lighting, certain plumbing fixtures, and landscaping can be segregated from the building. With cost segregation, an IRS-approved technique, these segregated assets can be expensed faster on a 5, 7, or 15-year schedule based on their individual depreciable lives, as opposed to being part of the building's 39-year straight-line depreciation schedule. What does this mean for you? Cost segregation is a great strategy for helping you grow your net worth faster by significantly reducing your current tax liability, using the upfront cash for additional investing. What would you do with cash you could borrow at 0% interest? Ready to magnify and intensify your wealth? Give us a call today. Here's to achieving your financial goals quicker and realizing your dreams sooner.
If you own commercial real estate, you should at least be aware of cost segregation, how it works, and how you can benefit from it. Here's a quick overview. Here's the building. When you buy or build a building, you separate out the land value from the improvements to the land, of course, because the land does not depreciate. What's left over, these improvements are considered one big asset, and you get a small depreciation deduction each year that represents the reduction of the asset's value over time. However, the tax law does allow you to reclassify this asset into components so you can benefit from greater depreciation deductions sooner. This tax strategy is called cost segregation. Here's how it works. First, let's look at site improvements. Site improvements are generally anything outside the four walls of the building on the property. Here's some examples. We can reclassify these components, get a cost to them as it relates to the cost of the purchase or the construction of the building, and then those costs and those items then can be depreciated quicker than depreciating the building. The building is going to be depreciated straight line over 39 years typically, or 27 and a half if it's commercial residential property. So there's site improvements. Electrical, we're going to break up the electrical into its components. Electrical distribution, that's the service entrance equipment, the electric panels and the breakers. The wiring, which includes the conduit, the wire, the junction boxes, and the switches. And of course the lighting and the outlets. Now depending on how this electricity is being used, this distribution is being utilized in the building, we can reclassify a component of it or a percentage of it as it relates to the work that's being done in the building, the type of building it is. Once we reclassify it, we can then accelerate the depreciation of those components. For cost seg, we have to quantify all these costs as it relates to the purchase price. So everything has to tie to the purchase price so that when we break up all the pieces, they add up to the same total cost of the improvements. All right, mechanical components. Some, but not all of the plumbing in the building can be reclassified as personal property. Here's some examples. The trick is to apply the body of law, which is a little complicated, but we have to apply the body of law to the facts and circumstances to determine whether or not we can reclassify it. All right, fixtures is next. Fixtures is generally anything attached to the floor, walls, or ceiling. Here's some examples. We have to identify, again, the facts and circumstances to see if we can reclassify it, and then we also have to quantify it, get the dollar value appropriate based on everything else that is part of the purchase. The next one is personal property. This is the stuff that comes along with the purchase. Whether you wanted it or not came with it. You may, down the road, decide to get rid of that stuff. With cost seg, we can identify its value, again, as part of the purchase price, so that when you dispose of it, you can get the depreciation for it. Without that, you are stuck depreciating the value of that stuff over the life of the building. The last part is the new stuff, partial disposition. Historically, the structure, the walls, the floor, the roof, the windows, the doors, you couldn't reclassify this stuff. This was always going to be and still is part of the 39-year, 27.5-year building, right? It's not personal property. However, with partial disposition now, if you replace the roof, we can dispose of the value of the old roof. Before, we couldn't do it. So if you put a new roof on, you were stuck depreciating, in essence, two roofs. The new roof and then the old roof still as part of the original purchase. Now we can get it out of there and get the deduction for it this year. And this is obviously good news for investors. All right, so that's cost seg as an overview and how it works. This is the numbers. This is how mathematically it comes out. We're going to break out that personal property into typically 5, 7, and 15-year personal property as opposed to 39-year. So if you did cost seg on a $500,000 office building as an example, and you did it the year that you bought it, here's some estimated expected additional depreciation to deductions this year, next year, and the following year. Right? Now let's say you didn't do cost seg. Let's say you've owned the building for 3 years and now you're looking at cost seg. The same building, but now we're 3 years into ownership, we have an opportunity called catch-up depreciation. So that same building, same numbers, we get more deductions this year because we are 3 years behind in the depreciation based on this model. So we get all that catch-up in the current year. So instead of $24,000, it's $85,000. Now let's say you wait till year 10 to do it. Now your 5 and 7 year property should be fully disposed, but you're only 10 years into a 39-year cycle without cost seg. So again, same model. Now we have over $100,000 in deductions available this year. And you can see here, as is with all cost seg, eventually we have fewer deductions in the future because we took them early, right? And ultimately what that looks like is very simply, we say that this is a interest-free loan from the government. In other words, you're going to pay your tax bill this year with or without cost seg, and with cost seg, you can pay less this year. You'll eventually have to pay the same amount of tax because you're going to get all the depreciation one way or the other, but if you can hold on to the federal government's money interest-free, then you can reinvest that, and the return on that investment while you're holding the money is really what cost seg benefit's all about. So does that look like that in numbers? I'll give you some examples. Let's say you need some cash for renovations of a new purchase, or perhaps you're looking for cash for your down payment on your next acquisition. Right? Ultimately, there is no cheaper money than an interest-free loan from the government. That's what we're doing here. Right? Let's say you borrowed $40,000 commercially from a lender at 5.5% interest as an example. He's going to charge you a loan origination fee, and you're going to pay it off over the life of the building. Let's say there's 25 years left. Your monthly payment would be $245 a month. But your first month, 183 of that is interest. So after 300 payments, your total cost, your interest on this borrowed money that you're paying is $33,000. Now let's say you brought that back to today's dollars, right? Assuming a 2% inflation rate, right? You bring that back in today's dollars, you're going to spend $28,000 for the right to borrow $40,000. What cost seg is doing at a fraction of that cost is getting that $40,000 loan without having the interest payment. That's what the benefit is. So if this is of interest to you, call me. We can walk you through over the phone very quickly at no cost. We can answer any questions you have about cost seg. We can run a benefit estimate where we can show you your expected benefit based on your facts and circumstances. And then with that, we can then show you how to capture this cost seg benefit very efficiently. I look forward to hearing from you.
You're an innovator. You're continuously finding better ways to get the job done. Innovating simply means developing a new or improved way of doing business. Maybe it's about producing faster, more cheaply, at a higher quality. It's whatever you do to evolve your products, your processes, your capabilities so you can continue to compete in the marketplace. That's innovation. Whether you've just invented the latest and greatest product or you've simply figured out how to do more with less, you're innovating. And you've got to keep working smarter in order to compete with the company down the street and with the countries overseas. But it's expensive. That's why Congress supports American innovation with the R&D tax credit. They're literally investing in U.S. innovators who fuel our economy, protect American jobs, and keep our country strong. These federal incentives are intended to do just that by offsetting your cost of innovating. So if you're designing or producing products on U.S. soil and you're successful, then there has to be an R&D credit available to you. But if you're not taking the R&D tax credit, you're at a disadvantage because you're spending more than your competition does to innovate. Now, you've earned this incentive, so without it, you're actually paying a premium just to stay in the game, and that jeopardizes your company. Your competitors are leveraging this credit, reducing their tax bill and reinvesting it in their enterprise, which means they're innovating at a lower cost than you are, and they will ultimately beat you if you're not paying attention. As financial advisors, we're also committed to supporting American innovation by giving you the information and education you need to evaluate your opportunity to leverage this credit. In fact, we belong to a network of CPAs across the country that has captured tens of millions in R&D tax credits for businesses just like yours. We are efficient at showing you how to identify your qualified R&D activities and what that means in dollars saved by reducing your tax bill. In a brief, no-cost education call, we can quantify your R&D benefit and show you how to capture it. We want to support companies that are getting the job done. Let us show you how we can help.
Zip or pull the tape to reveal the screws, designed to be removed in one piece. Here you can see the workers removing the screws. Here you can see the removal of the panels. Pull the panel through the remaining screws or nails and stack the panels for reuse. You see, it's just that simple.